Hello and welcome to episode 59 of Prosperity by the Pint. I'm your host, Brice Carter, certified financial planner, chartered financial consultant, certified investment management analyst, and self-proclaimed millennial money expert. This is Quarantine Edition. Once again, this is a podcast where we talk about money, investing, business, and life success, all while having a cold beer. If you're watching at home, you'll notice the nice girly background that I have. Upgrade to my wife's office, aka my studio. Hopefully changes coming to that soon. But wanted to get right into this business this week. I'm going to be talking about why stocks rise on bad news. And this week, the cold beer is from Founders. It is Founders, which is out of Michigan, Grand Rapids, Michigan, one of my favorite breweries. They do a lot of seasonal stuff. This is the beer. It is the 4 Giants IPA. I think it's a limited release. 4 Giants IPA, 80 IBUs, 9.2% alcohol. Here we go. Cheers. That is delightful. They should not make this a limited release. They should make this a go-to. That is amazing. So this week, I got a phone call. Well, I've gotten a lot of phone calls recently. But recently I got a phone call from a friend asking, it was, I think last Thursday, might have been the Thursday before. Every Thursday morning, the initial jobless claims report comes out, and basically how many people became unemployed from the previous week, and that number is released. So the previous all-time high before coronavirus was something like 600,000 at one point in the 80s in a week, and gosh, that's a terrible number. On March 26, 3.3 million initial jobless claims. So what is that, 5 times the previous high? On April 2nd, it was 6.87 million. And I'm reading these numbers, so forgive me. Normally I don't do that. You guys know that. On April 9th, 6.615 million. On April 16th, 5.24 million initial jobless claims. And so you're looking at, over 20 million jobs in 4 weeks that were lost. That's basically all of the job growth from the previous decade. Now, we certainly anticipate or hope at least that this is going to be short-lived. But the thing is, the reason I got a phone call from a friend asking what is going on with the market is because one of the days in which, several of the days actually, to be precise, all 4 days that I laid out there, when we had 3.3 million, 6.86, 6.6, and 5.24 million, the market was up. So the market, it was clearly terrible news, just horrible news. And my heart aches for everybody that lost their job. But damn, why is the market up? That's the question, right? That's the question I got. And so I tried to explain, but I wanted to give some other examples. So you guys remember me talking, if you've been a listener for a long time, I've talked about in the past how Apple would have been one of the best investments of all time, but they were losing money when they initially public debuted. Same thing with Amazon. Same thing with all of these IPO. IPO stands for initial public offering. That's when a company goes from private to now being a publicly traded company where you can buy and sell it on markets. So these IPOs last year, they were called white unicorns, or they were unicorns. And they were these tech companies that were just kind of big companies that were going public. You're talking Lyft, you're talking Uber, you're talking Beyond Meat, you're talking Zoom. Most of them were losing money. In fact, Uber, in their IPO documentation, had no clear path to positive profitability, to positive earnings for something like 4 years. They're like, we just don't know. We don't know how we're going to make money. We know we can generate revenue, and they did pretty darn good. I mean, relative to the market, they lagged last year, but they're doing pretty darn good this year. So, you've heard me talk about how you can have companies that are losing money but still have an intrinsic value attached to them, or at least a market perceived value. So why doesn't it make sense that the market would rise on bad news? And I'll get to that specifically in a minute. Just today is the day I'm recording this, which is April 29th. Lyft announced layoffs. Lyft, the ride-sharing app, very similar to Uber. Now, the broader market was up today, but Lyft rose 4% on that news. They were going to cut 17% of their workforce. And we're not talking about these contract drivers that are not actually employees. We're talking about 17% of the corporate home office employees, the people that are, likely have stock options and employee benefits and health insurance and all that stuff. They're cutting 17% of their workforce, and their stock was up 4% today. Uber, rumored to be cutting their workforce, up 4%. They were up, I think, 5% today. Google announced earnings last night, and their earnings missed, obviously, right? First quarter is terrible for everybody this year. Their ad revenue was off. Stock was up 9% today. You see this quite often, actually. Well, you'll see bad news, at least on the surface. If you dig deeper, we'll find out in a minute. But if you dig deeper, there might be some good news. But on the surface, you see just tragically terrible news about a company, and their stock will go up. Why? So why do stocks rise on bad news? So let's look at this one piece at a time. So the first thing I want to address is the broader market and what was going on here with the unemployment numbers. Beer break, because this is good. It's nice to be drinking some craft beer. Again, some of the stores are starting to get easier to do some shopping at and stuff. So I was able to pick up this Founders for Giants at the local liquor store. Liquor stores are never closed in Michigan, but I could only make it out of the house so often with a toddler and a baby on the way and a wife that was getting short on patience for me doing a beer run. So I digress. Why was the market up with all these unemployment numbers? Well, the best way that I can explain this is the market is extremely forward-looking. So if we go back to February 19th, that's essentially when the market peaked before this major crash. The coronavirus really was not a big deal yet in the U.S., right? We really hadn't had states starting to shut down the economies. We hadn't had the federal government starting to mandate social distancing, really. The number of cases in the U.S. was very small. Granted, testing was very small. You had a laundry list of things there where if you were looking at it and you were an optimist, you'd say, why is the market starting to downdrift? In the first couple of weeks, that's what most market participants looking at. The market is overreacting. The market is looking at this thing and planning in a worst case scenario, or the market was too high to begin with. It was up 30% last year. It's okay. It can lose some now. That's what the market was looking at. Many market participants. But what the market was looking at was pricing in a worst case scenario. It started to look at projections and say, what could come of this? What if the Spanish flu, where you have a 4% mortality rate, what were to happen? What if? So the market always has this little ear, it has this little devil and angel on either side, right? It's whispering into the ears of the participants saying, this is the best case scenario, this is the worst case scenario, this is the best case scenario, this is the worst case scenario. And because the market is essentially the collective wisdom of all investors. Some are going to be buyers, some are going to be sellers at any given time, right? So when the sellers are winning the argument, or at least in theory winning the argument, the market will go down. And so what you had happening and starting happening in February was the market was looking at the scenario and saying, at least more people than less, or enough big investors to say, and that's what I think. I think it was ultimately very large investors, not your everyday investor that was started to sell off in February, and say this could turn bad, right? And so you didn't really have bad news yet. You really had pretty decent news. I mean, limited cases in the U.S. There's only 80,000 cases in China. If you believe that data, nobody does believe that data now. But if you believed it at the time, 80,000 cases in a city or a province of 12 million people, you only had 3,400 deaths. I mean, you're looking at that data and say this thing is overblown, right? Well, wrong to listen to China. So the market's looking forward and saying this is what could happen. So the market was forward looking. It bet in the bad case scenario. That's what happened. Now, March 23rd was the lows. March 26th was this first unemployment report that where it really started to factor in all the economic shutdowns and everything. And it was 3.3 million. The only reason I can really say that I believe the market was up that day is that shutdown, or that number, although bad, was not as bad as what some had anticipated. So think about that for a second. Expectations matter. If the market believed that instead of 3.3 million, it was going to be 4.3 million, hey, things aren't as bad as what we thought. And the market was up 6.25% that day. 5 times the previous high for unemployment claims, and market was up 6.25%. That's an amazing day, right? Like 6.25%. I've told people, in a balanced portfolio, expect 6% a year. Expect 6% a year. 6.25% one day. 3.3 million unemployment claims. That is unbelievable. But the market must have expected a higher number. The next week, 6.86 million. We more than doubled. More than doubled 5 times. The number before was 5 times higher than the previous. 5 times higher than the previous. And then we doubled it. So we're 10 times higher than the previous. The market was up 2.28%. That's a damn good week, month, quarter. Any way you look at it, that was a good day. 6.61 million the next following week. That was 4.9. Market was up 1.45%. Following week, 5.24 million. Market's up 0.5%. That's terrible news. Why was the market up on this terrible news? Market expected worse news. Improving news. News that is bad, but not as bad as it could have been or was expected, is good. Right? So it doesn't matter if a company loses money. It matters if they lost less than they were supposed to. It doesn't matter if the economy shrinks. It matters if it shrinks less than it was supposed to. And the market will rise on that news. Right? So right now we're essentially in a week ago, 2 weeks ago, most states were very limited economic activity. We were in kind of the worst place to be as far as the coronavirus pandemic. We're probably going to look back and say that was the low of economic activity. Yet the market is up something like 19% since that March 26th jobless report, right? Initial jobless claim. And so why is the market up 20% since then? Because the market is looking forward. It's looking towards what will happen in the future. It is saying we got ahead of this. We went down before the economy was shut down. We're going to go up before we see the economy reopen and activity start to pick up. So the market is a forward look. So 2 points on this. One, market is very forward looking. It does not look at what happened, what's happening today. It does to a certain degree, but it mostly looks forward to what's happening tomorrow or next month or next quarter. And the only way it really impacts the prices today, when you get news today, is if that news is then extrapolated to say this will have a negative impact X amount of weeks from now, right? So like us reopening the state today or the federal government or economic activity has a positive effect 3-4 weeks from now. So the market's pricing that in, or next quarter or next year, right? So there's 2 things really, is the market is very forward looking. And expectations matter. It doesn't matter if it's bad news, as long as the bad news is better than it was expected to be, right? So Amazon can lose money this quarter. They're probably not going to, but Amazon could lose money this quarter. But if they're expected to lose money and they lose not as much as they were expected, they'll go up. If Amazon is expected to make a boatload of money and they only make a half a boatload, their stock will go down. So it's profitable, right? But if it is not as profitable as it was supposed to be or expected to be, it will go down. So expectations are ultimately what matters. So if you have a situation in which right now that we're looking at, and we have lost 20 million jobs in the last 4 or 5 weeks, and the market is rising, I don't blame anybody for picking up the phone or wondering themselves what in the hell is going on. Unless you study the markets, you're not going to understand the simple concept. Well, hopefully you do now, because if you listen to the podcast, it's simply this. It's that the market looks for better news than what was expected. Doesn't matter if the news is bad, just better. And it's also very forward-looking. It's 2 things to take away. Market's forward-looking. Market looks for news that's better than what was expected, even if that news is bad. It's what is unexpected that kills the market. That not kills it, but hurts it, right? So quick review on this beer here. It is a bit of a piney IPA. I find it absolutely delicious. I love it. Founders for Giants IPA. If you find one, pick it up. This came in a 4-pack. And gosh, I could go for all 4. Quarantine Edition podcast. Don't forget to subscribe. YouTube, Facebook, Spotify, iTunes, Stitcher. Wherever you are, that's where we are. Cheers. The topics that I discuss in this podcast are meant to be general information and educational only. I'm not giving you specific advice because I don't know you personally. In order to give you specific advice, you should work with an advisor, someone that can learn your specific situation and give you advice that applies to you. If I talk about a specific security, please keep in mind I'm not recommending that security. And don't forget, investing involves risk. When you invest, there's always the possibility of losing capital, which is why you should consult with a qualified, licensed financial advisor prior to investing.